Additional tax on certain income, profits, and gains Section 99D. The bill proposes to insert a new Section 99D additional tax on certain income, profits or gains, by which, for any of the preceding 5 tax years from the tax year 2023 and onwards, in addition to any tax charged, paid, or payable under any of the provisions of the ordinance, an additional tax shall be imposed on every person who has any income, profit or gains that have arisen to any person or class of persons due to any economic factor or factors that resulted in unexpected income, profits or gains whether or not disclosed in the financial statements. Federal government through a notification in the Official Gazette may notify the following. Determine the economic factor which would lead to unexpected gain or profits but not limited to international price fluctuation having bearing on any commodity price in Pakistan or any sector of the economy or difference in income, profit, or gains on account of foreign currency fluctuation. Provide the rate not exceeding 50% of such income, profits, or gains. Clarification is required. Scope, time, and payment of tax payable. Exempt any person/income or classes of person/income from additional tax. The proposed section, besides enabling the government to levy such tax, does not provide any specific details as to the levy of such tax. Further, the time limit of the preceding 5 tax years is also ambiguous and should be clarified when a notification is issued for the matters discussed above. If the intention is to levy such additional tax retrospectively, then the law should provide for that. This section is an enabling provision providing the legislature the power to levy and collect additional taxes from such sectors of the economy which have benefited in the form of income in the past few years or may benefit in the future due to any economic factor. It is a known fact that certain sectors have benefited disproportionately in the recent past due to high volatility in the currency market, which resulted in a loss to other sectors in the economy, triggering record inflation which resulted in high interest rates by the central bank. Unexplained income or assets Section 111. Currently, tax authorities cannot raise queries under Section 111 as to the source of income from a person in respect of an amount of foreign exchange remitted from outside Pakistan through normal banking channels not exceeding 5 million rupees in a tax year that is encashed into rupees by a scheduled bank and a certificate from such bank is produced. The bill proposes to enhance the limit from 5 million rupees to $100,000. Before Finance Act 2019, the limit was 10 million rupees, and before that, there was no limit on account of foreign exchange remitted from outside Pakistan. Considering the abysmal state of US dollars reserves available with the central bank, this amendment is introduced to encourage the inflow of foreign currency into Pakistan. However, this policy may once again promote money laundering and the inflow of untaxed money from unknown sources. This may also create problems for the government in terms of compliance with the FAT framework. Explanation on adjustment of minimum tax Section 113, 2C. The bill proposes to insert an explanation, clarifying that the unadjusted minimum tax paid shall be carried forward to subsequent tax years and shall only be adjusted against the normal tax liability payable under Division 1 or Division 2 of Part 1. Providing tax rates for individuals, ops, and companies, of the first schedule to the ordinance. The above explanation seeks to remove the ambiguity and practice followed by the taxpayers, whereby the unadjusted minimum tax of prior tax years was adjusted against minimum tax liability under Section 113 of future tax years. Recovery of liability outstanding under other laws Section 146D. The bill proposes to insert a new section to initiate a recovery by the Commissioner of Inland Revenue from any defaulter in respect of outstanding liability payable under any other statute or law for the time being in force. A. Treated as income tax arrears in that law. B. Required to be recovered or collected by Commissioner, Inland Revenue, or C. Is referred to Commissioner, Inland Revenue, for the recovery. The Commissioner, Inland Revenue, shall recover the said liability and deposit the receipts in the designated account specified in that law. These provisions are introduced for enabling the Commissioner of Inland Revenue to recover outstanding non-tax revenue under any other statute or law. Payment to non-residents Section 152(5)(a). Current provisions require the Commissioner to issue the exemption certificate/order within 30 days of the filing of the application by the person who intends to make payment to a non-resident person without payment of tax. The said period of 30 days is not mandatory. The bill now proposes to insert 2 new provisos under Section 152(5)(a) which further explains the procedure of applying for an exemption certificate while making payments to non-residents. The proposed amendment introduces a mechanism for the automatic processing and issuance of exemption certificates by IRS, where no action is taken by the concerned commissioner after the lapse of 30 days of the filing of the application by the taxpayer. It is also proposed that the Commissioner may modify or cancel such certificate of exemption as issued by IRS based on reasons to be recorded in writing after providing an opportunity for a hearing. This automatic issuance of a certificate by IRS is a step forward for the digitization of standard procedures to facilitate the taxpayers for the very purpose of payments to non-resident persons without deduction of taxes. This would be also a source of big relief to the payers and the non-residents, as currently in the majority of the cases the commissioners take months to either accept or reject the application. Export Section 154(3)(b). The bill proposes to include exporters duly covered under Export Facilitation Scheme 2021 under Section 154A for tax deduction at source whilst making payment to an indirect exporter. FIBER issued the SRO 957-1/2021 on 9 July 2021 to announce the Export Facilitation Scheme 2021, EFS 2021, for exporters, manufacturers cum exporters, common export houses, commercial exporters, and international toll manufacturers, along with a pronouncement that all existing old schemes shall be phased out in next 2 years since then. The proposed amendment seems to cover such categories of exporters as defined under the EFS 2021 in addition to those categories covered under Duty and Tax Remission for Exports Rules 2001 for tax deduction at source against payments to indirect exporters. Export of Services Section 154A, 2C. Currently, to avail final tax regime on account of tax deduction under Section 154A, every exporter involved in exports of computer software or IT services or IT-enabled services, where the exporter is registered with and duly certified by the Pakistan Software Export Board, PSEB, is required to file the sales tax returns with the federal and provincial tax authorities respectively. The bill seeks to insert a new proviso in subclause C of subsection 2 of Section 154A, which proposes to waive off the condition of filing sales tax returns for the exporters of computer software or IT services or IT-enabled services. The tax deducted under Section 154A1 is proposed to remain the final tax even though such exporters have not filed their sales tax returns with respective authorities. Payment of tax collected or deducted by swaps agents. Section 164A. Section 164A provides synchronized withholding administration and payment system, swaps, of tax collected or deducted for payment through digital mode. Under this system, the board will notify withholding agents to act as swaps agents and make payment of tax collected or deducted through digital mode and issue swaps payment receipt, SPR, against the tax deposited by them, within the time and manner as notified. However, this system is not notified through any SRO, notification, rules, etc. To date, the bill proposes to change the title of the Section 164A. Earlier this section was titled Payment of Tax Collected or Deducted by Swaps Agents. The bills have proposed to change its title to Settlement of Transactions Liable to Withholding Tax by Swaps Agents. There is a likelihood that FIBER may notify this system soon to take a step forward toward digitization. International Center of Tax Excellence Section 230J. The bill proposes to insert a new Section 230J to establish an institute which would be known as the International Center of Tax Excellence. With this proposition, FIBER intends to develop the following functions at the national and international levels, which are as follows. Development of tax policy. Preparation of model national tax policy. Delivering interdisciplinary research in tax administration and policy. International tax cooperation. Revenue forecasting. Conducting international seminars, workshops, and conferences on the current issues faced by tax authorities in the field of international taxation. Capacity building of inland revenue officers. Tax analysis. Improve the design and delivery of tax administration for maximizing revenue and any other functions as directed by the board or the federal government. The proposed institute would be a composition of nominating committee and executive committee. Nominating committee would be comprised of the federal minister in charge, the Secretary of Revenue Division, and the Secretary of Finance, whereas the executive committee includes Chairman FIBER, member, IR Policy, member, IR Operations, and 2 independent members appointed by the federal government. The procedures of recruitment, remuneration, and other procedures may be prescribed through rules for special purposes, and this information will be kept confidential under Section 216(7). Advance Tax on Cash Withdrawal Section 231AB. The bill proposes to introduce new Section 231AB for the collection of adjustable advance tax by every banking company at the rate of 0.6% on the total amount of cash withdrawals exceeding 50,000 rupees in a single day by a person not appearing on the Active Taxpayers List, ATL, issued from time to time by the board. This proposed amendment is the restoration of earlier omitted Section 231A of the ordinance, which was aimed to assist the government to broaden the tax base and documentation of the economy based on the filer and non-filer status of the countryman. Previously, such provisions did not provide the expected outcome, and as per some reports it promoted a cash economy. It also appears that the person whose income is exempt from tax or not liable to tax would also become subject to this sort of advance tax collection on cash withdrawals, because the proposed amendment does not exclude such cases. Advance tax on foreign domestic workers, Section 231C. The bill proposes to insert a new Section 231C to collect an adjustable advance tax of Rs. 200,000 from the agency, sponsor, or from a person engaging services of a foreign national in Pakistan. This proposed advance tax is required to be collected at the time of renewal of a domestic aid visa to any foreign national working in Pakistan. The responsibility for collection and deduction of this advance tax lies with the authority issuing or renewing the visa. The proposed tax under this Section 231C would be collected from the agency, sponsor, or from any person who engages in the services of a foreign national in Pakistan and is adjustable from the liability of that person for the relevant tax year. Advance tax on the purchase or transfer of a movable property, Section 236K. Section 236K provides collection advance tax deduction on account of the purchase or transfer of a movable property in Pakistan. Currently, a proviso to subsection 2 of Section 236K treats the advance tax deducted as final withholding tax for the non-resident individual holding a Pakistan Origin Card (POC) or National ID Card for overseas Pakistanis (NICAP) or Computerized National ID Card (CNIC), who has acquired the said immovable property through a Foreign Currency Value Account (FCVA) or NRP Rupee Value Account (NRVA), maintained with authorized banks in Pakistan under the foreign exchange regulations issued by the State Bank of Pakistan. The bill now proposes to exclude such non-residents from withholding tax on the purchase or transfer of a movable property in Pakistan, and accordingly above referred proviso as to treating tax withholding as final tax for such persons is also proposed to be omitted. This is all for today's video. Further detail is in my next video. These were the changes and amendments made in the whole taxation system of Pakistan in the budget 2023-24. If you like my video, please hit the like button and subscribe to my channel so that you could get my upcoming videos.